Welcome to the Dividend Talk podcast, episode 109. Invest the mistakes we made in the past. Hey guys, welcome back to another episode of Dividend Talk. Today, European DJ and I will talk about some of the investing mistakes we've made in the past. We have some news of the week and, of course, questions from our listeners. All that and more. See you on the inside. Hey, European DJ. How are you?
I'm really great. Thanks for asking, Derek. And it's midsummer, spending a lot of time with my kids. My vacation is unfortunately ending. So this week, again, I went to a really nice water park here. But I must say, life is good. If you just turn the TV off and don't listen to the inflation numbers and what's happening in America and everything, then I can tell you, life is really good. How about yourself?
Well, I can tell you, we missed last week's show because I was completely off the grid. We went on vacation, which and we extended it. The weather here is fantastic, 28, 29 degrees. Unfortunately, all good things come to an end, and I think Sunday is the last good day of weather, and then it's back into rain. So kids, they're not inside, no one's inside. We are completely outdoors for the next few days. So it's like you said, life is good, and it's good. It's good to have sunny weather at last. It took us till August, but we got there.
Nice. So, hey, this maybe then also an official apology to our listeners that they didn't see anything upcoming last weekend. But guys, sometimes like life is too good and just get ahead of us. But we're back, and we hope we can make it a nice episode for you guys today with some golden nuggets. If I already saw some of your show notes, Derek. But before we get started on the main topic, did something catch your attention this week in the news?
The only thing that popped up was Disney. I see their share price this week. When I finally got back to the land of the living, I noticed their share price popped up a couple of percent, and it looks like they are back. We know COVID-19 had a huge impact. Amusement parks and so on were closed, but not just that. Disney Plus, their subscriber rates was pretty impressive this quarter as well. We had a huge increase. I think Disney Plus was up 31% in subscriber rates based on this time last year, which is absolutely huge. I don't know what Netflix was, but I know Netflix was stagnating a little bit. Yeah. So I was probably expecting something similar with Disney, but I have to say I was not expecting this. I was probably one of the people saying, how many people out there will subscribe to Disney Plus? You don't need it. But I mean, here they are proving me wrong. Their numbers are incredible, and it had a really strong quarter by the looks of it.
Well, I was one of their subscribers because it became available in Poland, I think 1 month or 2 months ago. So, they're still in the expansion mode, right? They're still accessing countries at the moment where they aren't yet. And Netflix is already for years here. So I think it's also quite easy for them to grow at the moment. But it just shows you how strong the brand appeal is. And I must tell you, my kids already love it, having Disney. They're tired of Netflix. It at a certain moment becomes a bit monotonous, right? So They start already shifting towards YouTube. As a parent, I hate it because they get sucked up in the YouTube algorithm. But as a parent here, I feel really comfortable them watching Disney because I also know that Disney curates a lot of stuff. And also, to be honest, I don't get all this woke shit in front of my kids all day. I mean, I have no issues with it if it's dosed, but it's becoming too much of a statement at Netflix, I think. So we're actually also planning now to cancel Netflix because I finished Stranger Things season 4. And we have also HBO Max, which we're sharing with someone. So I think it's getting too much, and I don't want all the costs. I'm still frugal. So we're going to cancel Netflix and continue with Disney going forward.
Yeah, we still have Netflix. My wife watches it more than me. She loves all these documentaries and so on. My kids are in that in-between age as an adult, you appreciate Disney and all the animation, but when you start becoming a teenager, you get to a point where you're too grown up for animation films. So that's where they are transitioning. They will not watch it. So there's no sense
Yeah.
in me, no sense in me having it. But I can certainly see for younger kids and young families the benefit of having Disney, especially over YouTube.
Yeah.
Man, I hate my kids watching YouTube. But
Yeah, me too. But look, how I always look at it, right? I call this a share of wallet. I think many consumers look at it like, okay, guys, I paid first for my cable. I paid like $40 or something like that, right? So I cut the card. I went to a streamer. But if you now end up with $40 again, yeah, you don't want to be 60 or something like that. And at the same time, because we didn't really touch on that, Disney is also hiking the prices really a lot, right? I
yeah,
mean, it's still cheap compared to the competition, but they are going from, I don't know, $7 to $10 or something like that
yeah,
for the basic package. So at a certain moment, the share of my wallet is then empty again, right? It's just a certain amount that I wanna spend, and then you start becoming selective if you because then you I mean, it's kind of full circle, right? You start with a cable with Canal Plus in Europe and all these kinds of things that you have all the movies. It went to streaming. You shift to Netflix. You cut your cable at a certain moment, and then 5 years later, you find yourself back at the same cost level again with the same kind of movies, but now just at a more user-friendlier way of accessing them. Let's say, because it all goes via streaming, and at the moment you want it. So I'm sometimes wondering what has this whole technological revolution done from the market. It has shaken up a lot. It put some companies really heavy in debt, like AT&T, by not knowing how to deal with this technological revolution.
yeah.
But I think 5 years down the line from now, we're back to it. I mean, they're starting talking already about creating, how is it, subscriptions with ads in it, with advertisements in it. So we're back to normal TV
Yeah.
soon, right? The only difference really from the whole technological revolution is that we can decide what to watch at our own time. But for the rest, we get all the ads again, and we still have access to similar content.
But look at it on the other side. As investors, like particularly say Netflix and Disney, we want them to grow, continually to grow. And for a streaming company, how do you do that? You either increase subscribers or you raise your prices. There's only so many people in the world with access to the internet or that can afford to have such things. You know, first world countries, maybe second world countries. So they have to increase their prices. It's just continuous pressure. There's pressure from all different angles, and I understand the company's perspective. I understand from the consumer's perspective. There's no happy medium. You're not going to make both sets happy.
Yeah. Yeah, and that's why I think that a company like Netflix has a narrow mode, in my opinion. I understand the brand appeal. Yeah,
Yeah,
I understand it, but it's not an Apple. I mean, the switching costs are so low that I mean, like now, literally in a click of a button, you can just cancel, right? And
yeah.
low switching cost. And the only thing with Disney is Disney has all this cross selling, right? So they have also the parks, and they can mix everything in, right, around just a new cartoon, or what is it, such a new animation. They
Disney
build it. Yeah,
Disney has a brand. That's what
it's
they
a
have.
flywheel. Yeah,
They have a brand. Netflix don't really have a brand. They have nothing to sell, only what you watch. Whereas Disney have a whole experience that they can sell, particularly to younger kids. Everybody wants to
yeah,
go to Disneyland when they're 6 years of age
yeah,
and meet their heroes, and they can sell that. Whereas Netflix don't have that. So that's the key difference, I think, between them. But I agree with you. These are companies like Netflix are narrow mode, and so it's probably one of the reasons why I've stayed well clear of them.
yeah. And what is just the whole pity of this technological revolution, that Disney had to also take a dividend cut. Yeah, because it wasn't only COVID why they did the dividend cut, right? It was also at the same time they announced then to invest heavily in streaming, to win the streaming wars, right? So we're talking now about Disney a lot here in this show, and yeah, I hope they will return to dividends one time again, because it is a company. If after the streaming war, if this whole market settles down a little bit, I could see myself one day stepping into Disney again. It's just a company I think that has too much appeal also from an investing point of view.
Yeah, I think they will. I think they will pay a dividend again. When, I don't know. Obviously, COVID helped them
Yeah,
make a decision.
yeah,
But I think they will. I think they will.
yeah. Good. Talking about investing mistakes. That was a nice dividend cut. I remember.
Yeah, I remember that. Or I think I bought them about a month or 2 months before they cut it. I mean, it was amazing.
Nice.
It's like they were waiting for me to buy and then said, "No, Derek, we're cutting that now. Get lost."
No.
But yeah, let's talk about some of these investing mistakes. I mean, I have 5 headings. Most of them are personal, are probably close to me that has happened, and so I'll just maybe start with the first one. And for me, that's not having a financial plan or any plan at all. I mean, I'm one of these guys that probably needs something, needs a target, needs a plan, needs something to go with. But I remember way back when I was starting, I opened up Bullion Vault. I was investing in a small bit of gold. I was trying to do some FX trading. I was trying to do so many different things without really knowing what I was doing, why I was doing it, or what I was even aiming for. I mean, what was the point? Was I just trying to make as much money as possible, or or what was I doing? So I think the key thing for me is making some sort of financial plan. I mean, this investing is not going to make you rich overnight, and I think it's important to know that. And you won't know that unless you write out a plan of what you expect and what's realistic, and then
Yeah.
go from there. I've given myself 10 years. I'm probably in year 3 or 4 now of that plan. So it's 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 going there, but at least I have a footprint now, and I have something to look back on when markets drop, or if a dividend is cut. I can look back and say, okay, this is the plan. I'm sticking to it, and keep going. Otherwise, you just keep jumping from strategy to strategy to strategy, making a little bit of money, losing it, make a little bit of money, losing it, and you're just kind of in a flywheel going around in circles.
So how did you build the trust in your own plan?
Over time, initially, as you know, I was following someone else with dividend investing, but I did know I wanted cash flow. I mean, from personal experience, there was a time where I was completely broke. I had no cash flow, nothing coming in. It was around the time my oldest son was before he was born, and I've always said to myself, I never want to be in that situation again. So I knew I just wanted extra security, extra cash flow coming in, more than just my job, because you can lose your job quite quickly. And when you lose your job, a whole other snowball effect happens. So I wanted something to come in. So that's probably why investing came up first. That proved difficult because of tax reasons, and then I stumbled into dividend growth. Following the dividend growth investor helped until I learned to build my own plan and become a little bit more confident in what I'm doing.
Yeah, nice one, nice one. I think that was for me also actually in the beginning a little bit similar because it's quite a commitment, right, to dividend growth investing. You're easily talking about indeed a decade. I mean, a decade of your life, right? So getting this conviction really had to grow on me. I mean, we spoke more about it here on the podcast, right? At a certain moment, it just dropped on me that okay, I want to take matters in my own hands, right? And my motivation was also really looking at the pension system and everything in the Netherlands, retirement system, and thinking this whole stuff is broken. And but then to get convinced, it took me, I think, still like a year to be fully convinced that yeah, dividend growth investing is it. And it really helped me to see the cash flow coming in. That's just mesmerizing about the fact like, oh wait, I'm now having 40 euros in this, and actually this pays now for my telephone bill for the rest of my life.
Yeah.
Yeah, and then it really started to occur on me like, okay, I can start replacing every bill step by step by step that I have going forward, and this is how I'll become, I said, financially free. But it's a long-term commitment, and I think this is also for new investors that are maybe listening now as well. Like, you need to be commitment to this because
Yeah.
we saw that last year was probably for me one of the toughest times sometimes, and I was able to suppress it, right? But this FOMO of all these kids that were like 21, 22, putting their pocket money in the stock market, and then suddenly making thousands of profits, you feel like I'm losing out, right? Is my strategy the right strategy? So, and you need to have conviction for your own plan. Luckily, I had it, so I really kept my head clear. But I think it's really important to have a solid financial plan.
Yeah, and you touched on it there. Like there was a lot of FOMO, a lot of different accounts making lots of money, and so on. But I think what was important for me was that I did my own risk assessment and I was honest with my risk assessment. I remember going back and you read always don't don't invest what you can afford, don't trade what you can afford. And I remember when I started FX training, going putting in a couple of thousand and saying, oh, if I lost all this, I'd be fine. And then it dropped 50%. And I'll never forget that feeling I had. It was nearly a gut wrenching feeling, you know, and I knew that the risk I thought I was able to have is not actually the risk I was able to stomach. So I think having that honest conversation with me, it always reminds me of a Mike Tyson quote. Everybody has a plan until they get punched in the face. And for me, that at that time, I thought I was able to handle a lot more risk than what I actually am. I'm very, very risk adverse in everything, not just investing in most things in life. I'm very risk averse. And I had to be honest with myself, particularly in investing, saying, okay, I don't really want to invest in high growth stocks because if it drops 50%, I know I will panic. I know I will sell. I know all these things. So finding a strategy where price is not as important, where you can nearly ignore the price was
Yeah.
really key for me. And I think that's probably what gave me the most conviction in this.
Yeah, very interesting. And you know, this leads me also to one of my investment mistakes, and I must confess I still do this a little bit, and that's holding too much cash for too long. I specifically, you know, as a value investor, and this is where I struggle sometimes. As a value investor, everything looks always expensive. Yeah, it's a mindset which is not always helpful, and I can fully understand why Buffett said that he had to appreciate Charlie Munger saying, like, it's not only about the margin of safety, which you learn from Benjamin Graham, but you should also buy good companies at a fair price. Yeah. So what for me, at least, my value investment part of my mindset says, like, you know, you need to buy undervalued companies. And that's why sometimes I am at risk of underspending.
Yeah.
And I've been doing that in my early years of dividend investing, because I always felt like, oh, the stock market is so expensive in 2016, 2017. Well, we're now in 2022 and look where it is. Yeah. And I missed out on some really great opportunities by being too greedy at the time. I'm now really forcing myself to spend every month, but I also got a bonus this year, and my bonus has still not been spent totally, right? So let's say my savings account is having too much cash still on it. So I really need to push myself to spend it, and just to spend it. So you gave me some good advice earlier, saying, like, just put it in an index fund until you get those opportunities, pull it out, and then put it in the stocks that you want to have it. So I will look at that a little bit here. So in general, I'm spending every month everything because I pay myself first. But then you get this other money inflow from time to time. Also, my wife, right, gets some money in, and bonus and such. And that's where I'm still, let's say, on a learning path to spend it as much as possible quickly. And I think I need to start following more the lump sum approach rather than to how is it, average it out over the year.
Yeah, because one of mine is similar. I have something around poor value as well, and I think the key thing that Buffett is talking about, paying a fair price for a company. He didn't talk about undervalued or anything. It's just paying a fair price, and I think that's something that I forget sometimes. You try to target really undervalued companies, then that leads you to have a portfolio heavy in, say, Walgreens, which I had for a period of time, because they're undervalued. We know they're undervalued for quite a reason. Maybe they're not undervalued. Maybe they're fairly valued at the time. But it's value is such a hard one, and I've struggled and I've changed my mind with this over. I've tried cash flows. I've tried calculating it, and in the end, I realize I'm making a lot of assumptions that lots and lots of professionals probably do a better job than me. But it's really hard to predict the value of a company. Really, really hard. I think it's just better to focus on growing companies. I mean, we had an episode where I spoke about the top 5 things we look for. Basically, want cash flow growing, revenue growing, dividends growing, and low debt. I think that is a starting point, and then find the price you're happy to pay for that company. I don't think you'll go too far wrong. Once
Yeah.
once all those are growing, the share price should go with it anyway, irrespective of when you buy it.
Yeah. So I've actually a similar learning here, and that was also, how I said, a tendency to focus on broken companies. Yeah, so it's kind of the same, right? Because you mentioned Walgreens, but Intel is the same. And if you look at the bargains in the market, they usually are for a reason a bargain.
Yeah.
So if you are really following the value investing mindset a lot, you tend to fish in this pool of broken companies a lot. And you're effectively also betting a lot then on the management at the time. Think about 3M right now, for instance, right, with the litigations. We have Bayer with litigations. We have we have then Intel, I just mentioned, Walgreens. So you tend to get then a lot of broken companies, and also because the alternative all feels so expensive.
Yeah.
So I'm a true believer, right, in discounted cash flow, because I really feel like think that you don't want to overpay for your future cash flows. In the end, prices will come to the mean. And my portfolio is now since 2014, and it has also proven it. That there were, for all the stocks that I had in my portfolio, some have really done well. There were times you could buy them because there were some headwinds. I mean, think about Ahold, right? 28 euros now or something like that. It was trading at 15 or 16 euros because Amazon entered the market. I think they bought Whole Foods, and they thought like, okay, it's the nail in the coffin of the grocery chains, right? And my learning is that it happens usually once a year, that there is something like external to the company, which is driven by market overreaction, that pulls them down. Yeah, and I haven't seen it this year yet for one of the stocks. Maybe a little bit Castellum, that was irrationally priced. But I need more companies in a year, right? But I'm not a person that feels like paying buying a 1.5% yielding company with a 35 PE because cash flow is growing, dividend is growing, because I'm not going to wait 20 years before the yield starts to be, I would say, decent, right? So I'm hoping more on high interest rates, and that therefore the valuations of companies stay down and even get further down. I still think it has to be priced into the market. But yeah, a mistake I do have with this is that I end up looking a lot in the area of companies that have a story to it, which is not too pretty at times.
Yeah, and sometimes that's hard. Like Intel is a prime example right now. I think I was bullish on them long before you are. I'm not so much anymore. I'm starting to cool down on them, but I mean, it is a turnaround play, and that's what we're betting on right here. Luckily,
It's not a dividend stock for me. It's a turnaround.
Yeah. Luckily, they generate enough cash flow that their dividend for me is sustainable, at least for the next couple of years. But I mean, it's not of the same level as an Apple, for example, which for me is pretty safe for the next 10 years. It's a shame companies like Google or Amazon don't pay bigger dividends or dividends at all.
Yeah, true. So, but there's another learning that I have when it comes to, and it's maybe not directly related to my portfolio, but you know what I did? In December 2017, I was just working for a few years. I bought my first apartment. And I thought, I know I will live in here maximum 5 years. So I'll buy it, prices will grow, and then I will cash out, and I will have earned more than I can save.
Yeah.
Literally, like half a year later, shit hits the fan, housing crisis. My house dropped 30% in value, and it had to recover till 2016 on the price. So I mean, one lesson learned is there, if you need the money after 5 years or within 5 years, just don't invest it in something that can lose value, and don't assume that the asset you're investing in will be safe. And I truly thought that housing would be safe. And I can imagine there are other investments that we consider safe as today, but if you need the money in 5 years, put it in something like that is guaranteed. Put it in a deposit in your bank or something like that you can access again after 5 years. I would not invest. I wouldn't invest with that money. I really burnt my fingers on that one.
Yeah, and it's funny you mentioned that, because one of the big ones, that a common mistake, particularly in Ireland, you may have heard about the Celtic Tiger. House prices were booming, but that's the inappropriate use of debt. And I think people buying houses, especially to buy them to rent out, they don't understand that they're leveraging money. They're borrowing money to try and make money, and they don't understand how much debt they're actually taking on. It led to a lot of people losing a lot of money, families going broke, losing even their main houses as a result. And the reason I bring that up now is because I can see in Ireland right now that house prices are back nearly above the Celtic Tiger levels. They're nearly 5, 6 times what people are earning. It's unsustainable. Rents are at all times high. It's really unsustainable now at the moment over here. You can see a crash coming. When? Nobody, as you said, nobody knows. It could take 4 or 5 years to play out, but you can certainly see that it's not going to continue as it is forever, because people just can't afford it. So I think housing seem everybody says house prices always go up, and that may be true, but they do crash. And I know myself with my own house. I live here 12 years. I bought it just before the crash. It crashed, and only this year, so that's 12 years later, has it reached in value, market value, the price that I paid for it. So yes, house prices always go up, but it went down quite a bit while it still went up. So I think that it's important to understand what you're doing with your money. Like, if you're leveraging
Yeah.
that money to buy a house, you have to understand that. And you're right. If you need cash in 5 years, do not invest it in housing or stock markets. Even put it into a government bond, something that you're guaranteed your money back.
Yeah. And then I said, I mean, even government bonds, right? They are price sensitive. I mean, you can lose a lot of really a lot of money on that.
We
But
have we
yeah.
have some over here where you're guaranteed your principal back, so it's safe.
Okay. You mean from principal point of view?
Yeah,
Yeah, yeah. Okay, good. Yeah. So what is? I think it's just important to mention that because I also know a certain group of our listeners entered the workforce after, let's say, 2010. So they've never really seen something like we've seen in the great financial recession, right? And since then, mostly it has been only up with few dips. I would say I would even consider the COVID-19 crash a dip.
yeah,
Okay, well, it was maybe a crash, but it went so quick. It wasn't a recession, right? It wasn't something. There was so much money printing after it, and maybe we're now heading into a recession. I have no clue, but something that I've seen in 2008, 2009 that was really, 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 really deep, and yeah, and that's what makes you humble, let's say, towards such things.
yeah,
Yeah, and for me, I guess the last thing is more the psychology of money, where I make sometimes mistakes, and I'm a really an analytical guy and a rational guy from that point of view, and I think people that follow me on my blog and YouTube that see it also, right, in how I think and how I act. But I've got this unwanted roommate, as how I call it. Like sometimes people say angel on the left shoulder and devil on the right shoulder. I call the unwanted roommate that is whispering in my mind, saying like, "No, but the CEO said this, so it must be like that." And sometimes I still fall into this trap that I'm ignoring my rational mind, which, for instance, is saying like, but EDGI, the CEO's incentive is not the same as yours. Yeah, pump and dump or something like that. They might
yeah,
be under pressure. And then they give a brilliant interview. And I feel like, no, 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 the numbers, it will all be fine. But and I had, it took me years to come to the conclusion that probably CEOs are at the top, not because they are so great in these blue chip companies, but just because they were the best smooth talkers in the while climbing the corporate ladder.
yeah,
Yeah, and if I work in a corporate, I've worked always in corporate, so you need to be kind of a specific person. But those are not entrepreneurs; those are not founders, right? They are really good usually in giving presentations and all this kinds of stuff. So um, yeah, I've been falling into this trap with General Electric, Tupperware, and maybe now even with Intel. Who knows? But this unwanted roommate, I've been ignoring this person for too long. Or I've been listening to this person for too long. That's how I should say it.
yeah. suppose when it comes to CEO, they would be probably smooth talkers. I agree with you there, but I think it's the team around them that's probably a little bit more important to focus on, because at the end of the day, they are probably the ones doing the work. The CEO has all the ideas and he's putting pressure, but he's
Yeah,
probably he or she not getting their hands dirty. You know, probably not
yeah,
getting into the meat and bones. So it's probably wise to look at the team around him.
yeah, yeah. And what also my learning is stick to the numbers. The numbers don't lie. Yeah.
Unless you read IBM's numbers and they lie all the time.
Yeah, but still, gap numbers tell you something, tell you the truth. Yeah, and so they can't commit fraud.
Yeah.
And that's a good thing for us. That gap is still there to protect us. So all these adjustments, sometimes adjustments make sense, really, and I don't mind them then. But at least I get a better grab on it. Let's say.
Yeah. And the last mistake, I suppose, for me is just being honest about whether you're an investor or a speculator. And I've said it before, I've tried all sorts of different trading, but I always have that itch. And I remember we did an offline session with one of the members of the community, and we're talking about our goals for the year. And I mentioned that, like, I still like the excitement of trading, even though I don't like the risk associated with it. So you have to be honest. Are you a speculator or are you an investor? An investor buys, doesn't need to sell when it reaches a certain point and hold. I think options has been pretty good for me in that regard. It kind of scratches that itch. It's enough for me to be able to read charts and say if a price is going up. And now I'm at a point where I'm only picking companies I want to hold. I'm done with the likes of Solo and Wish, who are still in my account, but I learned that lesson. So, but I'm only picking companies. Like I opened up one recently on 3M at 140. Like I'd be happy to own 3M. So that's where I am. But options gives me that kind of trading, but not really, a little bit risk adverse than normal trading as well.
It's again psychology, right? And knowing yourself, it's almost like, and actually, it's what I also like about investing. It's together with growing up kids, right, and
Yeah,
raising them. You see always a mirror in front of you.
yeah,
Investing is kind of similar. You really get to know your weaknesses as well, and needing to deal with them, whether you like it or not, because otherwise it loses you money, right?
yeah. You have to face them. And Joe, I actually I haven't wrote on my blog, I think, since March. I miss writing because that kind of keeps me grounded, keeps me composed. And now that I'm
True.
going to be working a little bit less, I think I might get back to it, because it's something that I think I wrote the blog not for people to read, but for me to learn and grow. And I need to get back to that a little bit.
Yeah, that I would say so. I'm really missing your articles.
I know you keep pushing me all the time.
Exactly. Hey, thank you so much, EMF, also for sharing your mistakes, right? Because I know for some people it's hard to talk about mistakes and such about taboos. I think, after 109 episodes, for us, it's not such a problem anymore. But it was really good for me to go through this thought pattern again here as well, because I got already again some thoughts that I will have a thought about over the weekend whether I should do something with it. And for instance, with my cash from my bonus, I think I will just throw it for the first time ever all in an index fund. I just need to now figure out and make the choice which one, or I take 2 or 3,
Yeah,
and just use it as a store at least of for the money, because it is designated for investing anyway. So.
yeah. Remember, Bitcoin is not a store of value, no matter what you read.
No. I'm talking about a dividend growth ETF here.
I know.
Good.
So we'll move on to some of our listeners' questions. We have a few to get through. So we might start with, I'm going to let you pronounce that name.
So Panagiotis Pavlidis is asking about whether I opened already a position in Thule. No, actually not, but I have a buy order outstanding. I would need to check my DeGiro account what it is. I actually looked at it yesterday again because the old one expired, but it didn't hit my target price yet. So I believe it was 15 or 20% trading above it. And I'm a bit greedy on that one, although I like, of course, the company. I just want to pay a fair value. I'm not even talking about the margin of safety. I just want to pay fair value for this company. It hasn't hit it yet for me.
Cool. Tim Ann has asked us if you had room for only 2 real estate investment trusts in your portfolio, what 2 would you choose?
Yeah, so he's asking here, right? Realty Income, Store Capital, WP Carey, Simon Property Group, or Digital Realty Trust. So if I had to choose only from those ones, right, it would be Realty Income for sure. The second one, I'm giving the benefit of the doubt to Digital Realty Trust. I have an issue with Digital Realty Trust that is not really growing funds from operations over the last 4 or 5 years. I mean, let's say I'm probably a bit overreacting here, but it's not convincing me enough. But it's heavily priced, and it's in the most booming industry, like data centers, right? So I love this business model, but I want to see better financial performance from this company. But I will still choose it because of the secular growth winds in this industry. But how about you, Derek? Which one would you choose?
For me, probably Realty Income because I own them.
Mhm.
Maybe WPC, WP Carey would be another one. I know are they Dividend aristocrats or close to it? 24, maybe 25
Mhm.
years of dividends. To be honest, they're all not a bad option. To be honest, DLR is the one. It's probably the least I know, but
Yeah.
they're all not too bad. But I would probably go with WPC.
Okay.
They have a
Super.
decent yield, long history. From the last time I checked, the funds from operations was growing, but the last time I checked, that was maybe 2 years ago. So I don't know what's been
Yeah.
happening. I'm not current. I'm not current on them.
Yeah, and when I see Simon Property Group, I mean, good old Dividend Dane who passed away last year, right? And what was it? September, November. Every time when I see this ticker, I need to think about him because he bought a shitload of this during COVID-19 crash. I remember he was really pitching to us, and he did really make a lot of money with that one. And I'm just wondering, like, does his family even know that he has these shares, right? Maybe maybe it's still somewhere on his account compounding. Anyway, that's my story of Simon Property Group, guys. So, and Dividend Day was also one time on the podcast show here.
Yeah.
Having said that, we also got some fan mail. Casper, Patrick, thanks. Yes, we're back. And enjoy Sunday, this podcast when you're listening on your run. Really thank you for saying some nice words. But then the next question is from Victor, Derek. It's about 3M and their spin-off. What are you thinking about it? They want to spin off. What is it? I think their healthcare business.
Yeah, and is that's around the litigation as well, isn't it? It's they're just getting they're doing a Johnson
Yeah.
Johnson essentially.
As
And
well, but also I believe a healthcare company that they want to spin off.
yeah, I mean, it probably makes sense, particularly with what's going on. They're going back to what's true and tested. I know Russ, who was on the show, has done a video on it. To be honest with you, I haven't seen, I've heard it, but I haven't read about it a whole lot, as I was away. But my initial reaction is it seems to be a pretty good idea. We all know what's going on with the company at the moment, but going back to their core, but we've seen this. We spoke about this before. A lot of companies are going back to their core and they're spinning off segments that are kind of antagonistic to what their true values are. So it's an interesting one indeed for me.
I think the fall of General Electric was probably the first real big one to show us, to tell us that real industrials, like these companies that own, like, I don't know, half of the world, like media business, but also oil and gas, all combined, that it doesn't work. That the companies, the units are probably better off on their own, and it's a trend that we have been seeing, right? Many companies spinning off businesses. Even Philips became a healthcare company. What was it? We have then General Electric, of course, spinning off the healthcare business. I mean, many industrials have done it, and now 3M. So it's a trend that we are seeing. It just reminds me all the time that Siemens is such an awesome business. They are doing this just organically almost. They spin off the Siemens Energy. not a lot of noise around it, no litigations. This company is just such high quality. Reminds me again, I need to put back my buy order for Siemens at $100.
Yeah, I mean, it's interesting. You're right. Siemens do this the whole time. They're a huge conglomerate. They take over pretty much half the globe, and they just spin it off with no noise. But for me, I think it's the right thing to do. All these companies come in, they diversify into so many different areas. They have teams specialized. Maybe they're good in industrials, they're not so good in healthcare. So you're better off spinning off the company, get experts in there that know healthcare, know that market, and
Yeah,
watch that grow. But I think this equates to, is it about a quarter of
yeah,
revenue as well? So
yeah.
you're going to see
It's a big one. Yeah.
a huge drop in revenue from these guys.
So to answer the question, Victor, I think it's good. It's a good thing to do. Also, the litigation, the Johnson Johnson approach to it, I think it's all good stuff. We still need to have this. What is it? This other litigation, which is also affecting the Belgium and the Netherlands. There, this one is still having a huge overhang there. So 3M is not literally out of the waters yet with this one, but they're, I think, taking the right actions, and management is showing competence. Of course, if you're a veteran and you have now a hearing issue, I mean, this is not good. Of course, I'm looking here purely from a investor point of view.
Yeah, when our buyer going to learn a lesson and just spin off Monsanto.
Stop about buyer. Oh my God. Next one. Thiago is asking us about, do you have any real estate investments? Like not real estate investment trust, but real estate. Like, do you own something?
I would love to. I would love to own one or two properties, even a couple, maybe even more, 3 or 4 properties. I spoke earlier. House prices are so high over here, but the reason I'd like to do it more than anything is because I know my wife would be more involved in this. This is something that is tangible that she could understand. We own a house, we can rent it out, and she would like that as well. So for that reason, I would love it, but not at current prices. I'm not willing to put myself back in work for an extra 20 years just to get an extra house to rent out.
Yeah, it's I have the same. I mean, I guess it's here yielding 4% or something like that. Rent, average rent compared to average purchasing price. It's not worth it with all the risk that you get. But if I could get something, a property for 15% yield, yeah, and then of course you need to deduct the costs. I would, and it's let's say on 10 minutes driving distance, I would really consider it just from a diversification point of view, also to learn a little bit about how it is. But yeah, I think such a market we won't see anytime soon here. Then Wolf of Hardcourt Street is asking about your thoughts about ticker symbol CWH. No clue what it is from my side. And EPR, are the yields sustainable?
So the first one, CWH, is Camping World Holdings, and they're yielding about 7%. And typically they are specialized in recreational vehicles, vehicle parts, and they also sell supplies for, say, camping and so on. For me, when I hear the word recreational, I see something that with all this talk of recession, this is the first thing that's going to be impacted in my mind. I don't know exactly what parts they do or how important they are, but camping, I don't know how sustainable a 7% yield is. I quickly looked at their financial statements. I think they're around since 2013. So they're not kind of tried and tested through the recession. We don't know how they're going to react through a recession. The revenue, to be fair, is growing. It did dip quite substantially between 2017, 2018, 2019, but it's rising again. Earnings follow that. What worries me is that free cash flow per share. It's negative for the last 2 years. For me, that tells me the dividend is not sustainable.
Yeah.
Honestly, after that, I just stopped looking and kind of said, okay, dividend for me would not be sustainable. The second company, EPR, is a properties REIT, real estate investment trust. They're involved in kind of like amusement parks, movie theaters, ski resorts and stuff, and they own over 350 properties. Seems a little bit more sustainable. They've been around a long time, even through the last recession. We can see that they did dip in the last recession, but they recovered quite quickly. So I'd be a lot more confident with these guys. Free cash flow is growing. Obviously, 2020 had a huge impact on a company like this. Amusement park closed, all resorts closed. So you can see 2020 was quite a big hit. But as things start opening in 2021, they're back as far as where they were in 2016, and it seems like they're growing. So in terms of the question, I don't know the companies too well underneath, but I would say EPR Properties is more sustainable than Camping World from a dividend point of view.
Yeah. Yeah, the only thing I can say, because I don't know the camping industry, but I would expect it to be like anti-cyclical, because if I look at my own spending pattern, if I have less to spend, I would more opt for a camping than for how you say it, an all-inclusive trip in a hotel or something like that. But I really don't know how this industry is and what it does to stocks.
Yeah, and from the way I read it here, it's they also sell supplies and camping, which to me means that's a smaller part of their business. I don't know how big the camping part is. I think they're more in recreational vehicles and vehicle parts. I think that's
Okay.
the main business.
Okay, then Ellen is asking us if we no, it's a hypothetical question. If we would need to pick one and remove one stock from our portfolio, which one would it be and why?
Oh, for me, that's easy. I'd pick Orange. I mean, I have them as a short-term play anyway.
Yeah.
I don't think it's long-term. It's going to be in my portfolio forever. I think this rollout of 5G and they're doing some good stuff, but we all know it's capital intensive. I mean,
Yeah.
at the moment, Europe is quite hard, particularly in France and Spain. They seem to be struggling there quite a bit. Everywhere else in Europe seems to be doing okay, but I'm giving them 4 or 5 years and then I'm cutting loose.
Yeah. Yeah, so my pick would be in this case Alibaba. I still have it in my portfolio, right? Because I'm in it for the 3 years period that I gave myself. But I could sell it today as well if it's needed. So that would be an easy one for me. It's not a dividend stock, so it wouldn't hurt my cash flow either. So probably I'm cheating here on Ellen's question. Then Maart is asking, he would like to hear our thoughts about Roche and how is it specifically that we don't really speak at length about the stock in our podcast. He likes the long track record and the pipeline. Price has come down to reasonable levels recently as well. What do we think?
So there's a reason why I don't speak about them too much. I do really like the company. I've said that before, but I also do some writing for Sure Dividend on the side, and I have a list of 13 companies. Viatris is one, and Roche is another one. I don't like to. I mean, we've never said that I can't speak about them or write about them or anything like that. But I do respect the work that these guys do, and they do pay me to do it. So I try to keep them separate somewhat. So I don't give my full opinion here the whole time. Other than I really like the company. I think they do really good things. In terms of price, they are coming down. They're still a little bit expensive for me. I'd like them to come down a little bit more. But I don't think you could go too wrong with the company. My only issue as I don't own shares, and the only reason I don't own shares is that they are based in Switzerland and the tax is too high for me. I'll be paying 30%. But as a company, fundamentally, I think they're fantastic. Their values really resonate me. Just read their annual report. I'd suggest just reading it, and you get a real sense of what the company is like.
Super, thank you. The next question is from Jakob, and he is asking, are you seeing at the moment what we are experiencing now as a bear market rally or truly the end of the bear market?
I mean, it's hard to know. I do follow some really clever guys who do all these sorts of stuff. And long term, so your weeklies and monthlies, we are still technically trading in a bear market. And in the short term, we have a short rally. So it's hard to know until we start to see this over a period of time. It's only speculating. And I said that before. Am I a speculator or an investor? So I'm not paying too much attention to whether we are still in the bear market or is it a rally, other than seeing where my resistance and my points are for my put options.
So I cannot talk about stock market either. The stock market is sometimes also really early with things, right? So, but if you ask me like about a recession, there's something nice in Poland now. You can take a break from your paying your mortgage. So I'm going to apply for that. So I get some additional cash flow. And the banks are of course not liking it, but the government has just said here, okay, you can take certain months that you don't pay your mortgage, and I'm going to apply for that. But it's all to how you say it, because the market rate shot up here from 2.5% to 8%. So it's all to, I said, to take some pressure off of citizens, of consumers, right? So if we have these kinds of really, really tough, I would say, regulations coming in, right, to help the consumer, it's just telling me that it's really, really bad at the moment. Yeah. So and also with the inflation. So I think there's still a lot to come towards us. Usually what you see with the Fed interest rates, they always say that it takes 18 months to come totally into its effect of what it really means. And we have
Yeah,
seen this also with the money printing, right? After COVID-19 and the stimulus that they have done in America. It took also like 10 to 18 months. So I think we have, from economic point of view, I expect still a lot to come that is, it's not going to look nice
yeah.
to us.
But I mean, you're talking about European and then you're talking about US. I mean, I'm guessing we're talking about the US stock market here, which is completely different to Europe. I don't know if we're seeing the same rally over here. I think everyone is expecting a hard winter. There's going to be an energy crisis. We can't sell crops from Ukraine. There's a lot going on at the moment over in Europe that we're not really seeing that. In terms of America, that's slightly different. Maybe they technically, and I think by the technical term, they were in a recession. Was it 2 quarters or in a row with negative growth or something?
Yeah.
In technical terms, they were in a recession. But I don't know if they're feeling as much pain as we are over here in Europe.
But Derek, how many companies in America are pure play American companies?
No, they are multinational
Yeah.
companies, but I think they'll be able to weather it a little bit better than European companies.
Oh, that's for sure. That's
Yeah.
for sure. Yeah.
Dividend Yogi, I love that name. What would your top pick in a consumer stock be right now? He's quite well diversified, which is good. He owns 43 different companies, but it seems like all the big consumer titles have high valuation. Any idea? And PS, he owns Ahold.
Well, my ID will be Ahold. I think it's really after the earnings report, I think it's really, really, really doing well. If you look at a little bit still at the value play, you could consider Unilever. They had a relatively good quarterly report for the first time in a long time. But there's a reason why it is cheaper than the other companies, of course, because it has not been performing well over the last 2-3 years. So but if anything, I would probably suggest Unilever then, because if I look at the American consumer staples, I find them all way too expensive.
I think they're all expensive. I mean, I don't think you can go wrong with any of them. If you wanted to have one just to diversify, you have Mandela's, you have Unilever, but I agree they all do look quite high, and it's quite hard to get in at them at the moment. Okay, so James has asked us any advice on what to do with the Haleon and GSK stock after their demerger. Plus, do you see any value in either now after the drop in price from the Zantac litigation?
So first of all, we don't give advice here, right? But I can tell you my opinion, of course. Look, I've been ignoring GSK for many years already. Of course, it often pops up in the screener just purely from a yield point of view. It had 9 years without dividend growth. They might have hiked a little bit the dividend last year. I don't even track it too much, but 9 years flat dividend before at least. For me, it's a struggling business already for a decade, hence why I'm just ignoring GSK. And I know they are now spinning off the consumer business. I'm just happy that Unilever didn't buy it. And then with the litigation, I think they're in big trouble. If you've got, I said, we just see it with European companies that they can't deal really with litigations. So, and what I'm also learning, right, with litigations, if you look at Johnson & Johnson, 3M, Bayer, I think this takes at least a year, just generally. at least a year. So you have time to think about what to do. But yeah, GSK is for me a stock that I would never invest in based on how they are performing and how they are doing.
Yeah. They cut the dividend before, did they? Or am I imagining that?
I just know that they had a 9-year flat dividend. If I look at the dividend history, I just don't have the last numbers from 2022.
Okay. Gordon has asked us about earnings. So earnings come in all shapes and sizes and forms. What's your least favorite earnings report with regard to readability and transparency? And then the second part of that is, if you haven't got a lot of time to check earnings call, what kind of things, metrics do you at least quickly check?
So I've been reading a lot of earnings reports over the last 2-3 weeks, and there was one that I was really thinking about. Oh, what is this? An ugly earnings report? I just can't remember anymore which it was, because just trying to make a soup out of it was really hard here. So Gordon, if it comes back to my mind, I will look up your tweet and I will reply to you. But generally, anything where they are putting the headline. So some companies, what they do, they put in the headline, we had an amazing quarter or something like that, and then you look at the numbers and you think like, wow, what bad. Yeah. So I, first of all, it pisses me already off. No, not pisses me already off, but I said it just annoys me, let's say, when they put these kinds of headlines. And secondly, when they put mainly adjusted numbers in the first page of the earnings report, and you need to go to page 24 to find the real earnings numbers based on the accounting standards. Yeah, that's really what I dislike, because it costs me time, and I don't find it investor friendly and someone that is really interested in what the real earnings are.
Orange for me is really horrible to read. It's a hard read.
Are you reading it in French?
No, I read it in English, and that's worse.
Okay.
But it's even the colors, everything is horrible. It's hard to look at. It's like black and orange, real dark in contrast, and then even with the numbers, it's not as clear. But that's probably the worst one. The worst one I read. In terms of the second question, what if you're quickly checking, I check revenue number, sales, free cash flow, and debt, just to see if they are either growing or shrinking, and of course earnings per share as well. Just quite quickly.
Similar here. Yeah, and I usually scan if there's no, like I said, no major news that needs my attention.
Yeah. The last question then is from the investing dosage. Any views about Deutsche Post?
Deutsche Post. Yeah, so I quickly looked into it before the show. So I don't have a good understanding of this company. I use their services with DHL quite a lot. Can't complain about it. Always on time, always good. Never damaged packages. So that's all good. We just looked in it. Debt profile looks okay for such a company. Usually I expect more debt in such a company. I know it is also kind of an industry leader over here in North Europe. Dividend has been growing for the last 7-8 years. There was like a 2 or 3 flat years of flat dividend, but I don't punish companies for that in Europe. So balance sheet looked good. Dividend was nicely covered, 43%, I think. Payout ratio, their dividend policy, I believe, is between 40 and 60%. So honestly, if they continue just to grow their business, I think you're talking here about an interesting company that at least hits my screener numbers.
Good. Yeah, look good. We were flicking through just before. Looks like a decent European company. I'm not invested. Probably don't intend looking at them, but doesn't look like a bad option.
Yeah, same here.
Okay, awesome. That's the last question. Thanks a million to all the guys for all your questions. Again, apologies I missed last week. I was out sunning myself, getting that vital vitamin D that we don't get in Ireland too often. But much appreciated for all the questions, and that brings us to the end of the show, I think.